Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have John McDermott, Chief Investment Strategist at Symmetry Partners, Grace Glockner, Investment Team Member and Director of National Accounts at Scharf Investments, Brynne Zuccaro, Managing Director of Marketing at Golden Eagle Strategies, and Michael Cohick, he's Director of Product Management at VanEck. We're here to discuss opportunities and equities and sector investing and how to get exposure to those themes. It's great to have all of you with us. Welcome to Trade Talks, and we have a number of themes to discuss at the table. John, let's kick this off with you. Certainly momentum and the relative sectors have been, driving force in the market this year.
Yes, we've just recently launched an ETF called SMOM and SMOM on the Nasdaq, which overweight sectors that have recently done well. We use our momentum signals between 6 and 12 months and rebalance the portfolio fairly frequently to refresh those signals. And through our research, we found that momentum is at the stock level, also at the industry level, but it's also prevalent at the sector level. So right now, our sector momentum is about 70% allocated to technology, comms, and industrials.
Yeah.
Reflecting their recent strong performance.
Yeah, certainly has. And Grace, as we think about the strong performance and where momentum has been in the market, of course, we have to think about valuations as well as it relates to the broader market.
Yeah, that's a great point, Jill. And we're seeing that the broader market indices are trading near the valuation levels that we last saw during the internet bubble in 2000. And a lot of that is driven by technology, right? AI-related companies. If you look at the stock indices that track those companies, they're trading at about 50 times. And so it is a really strong valuation level, but we're looking at earnings growth being fairly strong from those companies. So the S&P 500 in the second quarter had about 7% earnings growth. If you strip out technology and AI-related companies, it was about just 4% for the index. So AI is really driving the growth that we're seeing in the broader market right now. However, these revenue models are still in development and have yet to be seen yet. So what we're doing with CAT and GCAT, our ETFs that we launched with Nasdaq, is really evaluating, are there companies outside of this AI kind of speculation that's happening that still have strong earnings growth but are trading at attractive valuations. And in that process, we're able to uncover companies that can benefit from AI through productivity gains, but aren't investing the huge dollars up front for the technology.
Yeah. Brynne, let's talk about the hypergrowth theme. What is that exactly?
So hypergrowth are companies that are generating 40+% revenue growth year over year. And it's important to emphasize sales or revenue growth because this is a top line number. We don't look at earnings because earnings can be heavily engineered. And if you're seeing that kind of top line growth, you know that that company is generating strong business momentum. They have a good model and they're scaling quickly. We also see a lot of money losing companies in this segment. Wall Street has a tough time analyzing these kinds of stocks. They don't have profits, but just think Amazon in the early 2000s or Tesla in the 2010s. These are companies that are accelerating dramatically, and we're seeing those come through. And they come through in all market conditions, and they come through in all sectors. So there's always a hypergrowth opportunity.
Yeah, and Michael, let's talk about product at a higher level here for a moment. What are the limitations that traditional sector ETFs have in capturing today's market leaders?
Well, there's been an interesting phenomenon over the last couple of years where a lot of U.S. listed companies, or a handful of U.S. listed companies, have just grown in market capitalization. And what we found is traditional sector ETFs that are out there currently in the space, they were not fully representative of the weights of those large companies. And that's really due to RIC diversification rules. So registered investment companies like ETFs, they have diversification rules, so no holding that can be over 25%, and the sum of holdings over 5% can't be more than 50%. And so you have this kind of disconnect between the performance that investors are receiving from traditional sector ETFs that are in the space now versus what they might expect from the well-known and well-followed sector benchmarks.
Yeah, so Brynne, that's almost why you can't get that kind of exposure to hypergrowth through traditional indices, almost for the same kind of reasons?
Well, from our view, these indices just move too slowly. They typically focus on more mature companies. Maybe they've gone past many of their explosive growth stages, but this is a powerful segment that has recently emerged. It was coined in 2008 by the Harvard Business Review, then later quantified in 2016 by the World Economic Forum. And research we've done at Golden Eagle has shown from 2009 to 2024, companies that are growing with 40% revenue growth have more than doubled the return of the S&P. So it's a big opportunity for us.
Which is why you're looking at bottom line growth versus
Top line.
Yeah.
Yep.
Right.
That's right. A lot of these companies, when I mention their money losing, they're reinvesting into that growth acceleration. So you're talking about companies that really have hit this dynamic pocket of growth, and we capture, it's, you know, if you can capture a hypergrowth stock in that state, you can do very well, and it's a diversified growth as well.
Yeah. John, you have an interesting point in your notes here when you look at equities in general, and you identify some of these investment factors through financial science. Tell us what that process is about.
Yes, at Symmetry, we serve advisors and their clients by building diversified factor portfolios, and it's all backed up by academic research that probably most of the viewers are familiar with. But I like to characterize it as we try to buy companies at a fair price, which is value, who have recently done well, which is momentum, that have strong earnings and are stable in terms of risk. So you could think about that as being value, momentum, profitability, low volatility investment put together. What are we doing? We're not trying to pick stocks per se and take overweighted positions in them. We're trying to find stocks that fit that criteria of fairly priced, profitable, low risk.
How often do those factors switch? Is it a quarterly basis or the model's dynamic?
The model's very dynamic. Some of the factors are more quickly moving, like momentum, where others, like value, tend to be very slow moving.
Yeah, especially in a market like we saw this year. I mean, some of the best investment opportunities took place in what could have potentially been a bear market. You know,
Yes,
if you were to separate out different timeframes within the overall year-to-date performance, one of the areas that you have identified is within the healthcare space.
Yeah, absolutely, Jill. So the healthcare sector is trading at valuations that, relative to the broader market, that we haven't seen in 80 years. So it's very attractive on a valuation perspective, and this is driven by concerns around drug pricing and regulatory, headwinds. But when you look at the long-term trends supporting the industry, they're still in place. Global health demand remains strong. Innovation is still taking place. And we're also still continuing to see an aging population, so we have that demographic trend benefit as well. And ultimately, these companies are companies that could really benefit from the AI technology over the next 5-10 years. It's estimated that about 30% of costs in the healthcare industry could eventually be taken out from AI.
Yeah, and you would think with the valuation, and just to your point, with demographics and how ripe healthcare is to insert more efficiency into the system, leveraging emerging technologies like AI, or what are the headwinds? Is it regulatory for the most part?
Exactly, yeah, concerns around, the current regulatory environment, there's obviously ongoing conversations around what drug pricing is going to look like for programs like Medicare and Medicaid, and broader concerns around that as well.
Yeah, so once that uncertainty is removed, that's when the valuation story starts to look really, really attractive. What sectors does VanEck currently address? Tell us about the product.
So we're new to the sector space with our ETFs. We have two that we recently listed here at Nasdaq: technology, ticker TRUT, and consumer discretionary, ticker TRUD. But we're really focused. We've listed, or we've filed for all 11 of the sectors, but we're focusing first on the ones that exhibit that problem that I discussed with your first question most prominently, and also the largest sector, the largest portions of the U.S. large cap space.
What differentiates the true sector ETFs from other types of sector ETFs?
So we're specifically trying to solve for that problem that I lined out, that you're not getting full market cap exposure to the largest names, and even in some instances with these customized benchmarks that have caps, you're overweighting the smaller cap names down at the bottom of the cap stack. So what VanEck has done is a hybrid approach with the true sector ETFs, where our portfolio team first holds stocks up to the 25-50 rule, and then we round that out with a relevant sector ETF for the sector that we're targeting, and that really brings us up to full market cap exposure for the large names like in technology, like NVIDIA, Apple, and there's a look-through rule which the ETF holding is exempt from. So the holdings in the ETF don't actually count towards the individual issuer limit. So it's a novel way to get around a complex rule.
Brynne, what are the current hypergrowth trends?
We're seeing hypergrowth emerge most recently in materials and finance, specifically metals and mining, specialty finance, asset management. But this is one of many trends you would see in hypergrowth. We haven't seen these kind of macro tailwinds since, for example, energy in 2022. It's one driver. So today maybe there's a lot of macro tailwinds, but we also see stocks that emerge due to technological innovation, due to AI, strategic pivots by companies and fast-growing industries, or just really strong leadership. And we look at all the stocks in the market and we find those stocks that are finding that acceleration, and they can be across all sectors.
Right, which is interesting because these variables and drivers is what makes this hypergrowth theme. I think interesting in particular, you had mentioned energy, and it's interesting how the energy conversation's been reinvigorated because of the demand that we're seeing from AI and other emerging technologies, right? So even the climate tech conversation, which has started to gain more steam, and it's because we need to satisfy this demand. So
that's absolutely right. And what is different about hypergrowth is we don't predict where it's going to come from. We systematically screen and we find it when it's happening, because hypergrowth as a phenomenon happens very quickly. So you really have to latch on to that trend early.
John, what about diversification?
So at Symmetry, we are very much fans of diversification in that framework. We try to have portfolios that are diversified across factor exposure, diversified across industries, regions, et cetera. The sector momentum ETF is a little different. It's used as kind of an overlay to a well-diversified portfolio that will move you towards the trend and in effect provide you overweight.
So what kind of investor would this be appropriate for? Someone who has, is benched to the S&P as an example?
I think it's would be a great replacement for an S&P 500 fund. We're value investors, so our portfolios tend to be value tilted, which you will by definition be underweighting, say, technology. And if technology is on a run, then sector momentum added to our portfolio will give you that technology exposure, bringing you closer to market value weight or even an overweight.
Yeah. So Grace, back to stock specific for a moment here. What are a couple of setups that you're looking for in the healthcare space?
Yeah, absolutely. One of the companies that we really like right now is Zoetis. So this is the global leader in the animal health industry. And their largest segment is the companion animal segment, where they earn about 70% of their sales, and it's about 65% margins for them. So this is a very attractive business. You think about, a lot of people are discussing the declining birth rates that we're seeing globally. This is a prime beneficiary of that, right? As people are increasingly viewing pets as a part of their family and maybe foregoing having children or having another child and have that opportunity to have a pet instead. And so we view that as very attractive. The stock is currently trading at an 8% discount to the market. It generally trades at a 60% premium because of the quality of the business. So this is a company that, like I had said before, strong earnings growth, attractive valuation comes together, and it looks appealing.
Well, I guess my 3 cats are helping.
Yeah, exactly.
Bottom line. Yes, they can thank me at the end of the day. Michael, back to the sectors for a moment here. What type of investor, how would you leverage these within one's portfolio?
Yeah, the concept was actually brought to us by a SMA manager who runs SMA portfolios of ETFs. They do a tax loss harvesting strategy. So the SMA managers using ETFs is a great example. Generically speaking, I just think asset allocators across the board. We have a model business, an ETF model portfolio business at VanEck, and the problem that I outlined at the top of the show, he very much was facing that issue of not being able to get to weight using the ETFs that existed. There were some workarounds that I don't think are very elegant that we had to face in order to try to get to market weight. But yeah, asset allocators, portfolio managers, and then any investor who's really looking to express an opinion on any of the certain sectors based on their asset allocation.
In the last few minutes here, as we think about outlook, and Michael, what I think is interesting here is that there's still so much room for innovation within the ETF space.
Yeah, absolutely. I think obviously the space has gotten very crowded over the last several years with the ETF world bringing much more democracy to the issuers. But I think there's plenty of space for companies to still innovate, and True Sectors is a good example of that.
Yeah. And John, I'll ask the same of you in a different way, as you know, whether Q4, looking out into 2026, how do you see the space evolving, or even if higher, level thoughts on the market in general?
The space as in the ETF space?
Yes.
Yes. Well, we think the ETF share class is interesting. We have a suite of mutual funds, so the ETF share class issue, the SEC gave Dimensional a kind of a strong feeling that it was going to work out. Would be a really nice thing for mutual fund investors, being able to switch out of the mutual fund format into an ETF share class and be more tax efficient and flush out some of those embedded gains in the mutual funds. I think that's going to be a big focus for us in 2026.
Yeah, and from your perspective, Grace, just again looking for those value plays and getting more clarity once there's more regulatory framework in place?
Yeah, absolutely. Continuing to kind of stick to attractive valuations. Luckily, the market has been broadening out, but it's been predominantly driven by companies with lower earnings quality, et cetera. And so we are still seeing a lot of opportunities for high quality companies still trading at very attractive valuations.
Yeah, and finally, to wrap up with you, Brynne, I'll ask the same of you as well. I mean, hypergrowth, your variables could change moment to moment, day to day.
Yeah, and that's great. We know how to find where the growth is emerging. I mean, I'm optimistic for the fourth quarter. I believe since 2008, 88% of Q4s have been positive. Earnings growth is looking strong next year, estimated at, I believe, 14%. But big picture, we came out of the 70s with computers, electricity, IT. We were in a third industrial revolution per the World Economic Forum. We've now entered the fourth industrial revolution. We're talking AI, automation, globalization. We're talking growth, things that will dramatically accelerate the economy, in my opinion. So I think the future for the stock market is quite bright. Of course, there's always corrections, but long term, the bull market, the secular bull market, is permanent.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.